At Crosby Advisory, we have a lot of different metrics, charts, indicators that we look at to give us an idea of what the market is doing. And one of them that we use is called a Relative Strength Index, or RSI. This was developed by J. Wells Wilder, and it is a momentum oscillator. And essentially what it does is it measures the speed and change of price movement. So to dumb that down a little bit, imagine a table that goes from 0 to 100. And the chart is telling us what the US stock market is doing. It doesn't have to be the US stock market. I could look at the RSI of Apple or Microsoft or Amazon. I could look at individual stocks. I could look at bond indexes, whatever I want to look at. Essentially what it does, to dumb this down, is it tells me if the particular investment that I'm looking at is potentially overbought or oversold. What does that mean? Overbought means that there's too much exuberance about it. People are flying into this investment and they're buying this investment in a frenzied pace. And maybe it's not really supported by the underlying metrics. On the other hand, oversold would be an investment that has collapsed in price. Maybe it has gone through a downturn. Maybe it has missed earnings. Maybe the earnings weren't quite as good as what we thought it was going to be. Maybe we were going through a recession. Whatever that might be, oversold means that too many people are selling it. The rate at which it has been sold is not justified because the stock is still a quality stock, or the stock can still add value at its price. And so relatively speaking, if I have a chart that runs from 0 to 100, if the investment that I'm looking at is at a 50, it's average. If it's 70, for the most part, we consider that overbought, too much exuberance. If it is at a 30, then we consider that oversold, too much pessimism. And as investors, contrarian investors, if we want to move opposite of the herd, potentially we want to buy something that has been beaten up, something that has been oversold. We want that deal. So one of the things I looked at is over the past 5 years, what if I took that S&P 500 index and I only bought it when it was at fair value? So for the first test I ran, I bought the S&P 500 not blindly on January 2nd. I bought it when the oscillator was only at 50. So I was pretty confident I was getting a fair deal on that price. Well, if I did that, I would have bought in January 2015. I would have bought in January 2016. I wouldn't have bought until March of 2017, March of 2018, January of 2019, and March of 2020. If there's a pattern here, what you're seeing is sometimes that oscillator drops down in March. And funny thing, right now it's March and the market's in a little bit of a sell-off position. So interesting to know. But hopefully the results of this lesson tell you not to worry about that. Anyways, if I would have done that and I would have only bought the S&P 500 when the oscillator said it was at 50, I would have drastically underperformed. Instead of winding up with $66,488 blindly investing on January 2nd, I would have wound up with only $59,724. But maybe 50% or maybe 50 on the oscillator is not as good enough a deal. Maybe it's not oversold enough. So what if I only bought that index when the oscillator was at 30? Well, if I did that, I wouldn't have bought it until September of 2015. So almost the whole year went by before I would have bought into that index. I wouldn't have bought into it until February of 2016. In 2017, I wouldn't have made an investment at all. So I would have had to roll that $6,000 over to the following year. 2017 was an interesting year. Every month that went by, the S&P 500 was higher than it was before. Fantastic year to be an investor. Don't count on a year like that in the near future. They just don't come along. But it happened, and we'll take it. So now in 2018, I have $12,000 to invest because I wasn't able to invest in 2017 because the oscillator never got to 30. And I wasn't able to make my $12,000 investment until March of 2018. July of 2019, I was able to push my $6,000 in, and then I wasn't able to invest until March of 2020. So where would I have wound up? Do I beat market return by using 30 on the oscillator to try to time the market? Actually, no. I underperformed drastically. Remember, there was a year that I wasn't invested at all, so I'm missing out on those dividends. And then my last $6,000 didn't hit until March 2020. And as a result, instead of ending up with $66,488 blindly investing on January 2nd, I only wound up with $57,392. The moral of this story, it's not about timing the market, it's time in the market if I'm a long-term investor.